Hey everyone, this is Dr. Tom Carr, aka Dr. Stoxx. I just wanted to give you a quick market overview, given that last week we had such a horrendous sell-off. This is kind of a late night excursion into the video realm here for me, so if I'm not completely coherent, I apologize, but I did want to get a dispatch off to you before the markets open on Monday. And I wanted to give you kind of some good news and bad news. Let's talk about the bad news first. This is a chart of the Volatility Index. It is a current up-to-date chart, so you can see this big stick here off to the far right edge is reflective of Friday's trading last week. VIX went from around 12 to 13, where it's been stuck for several weeks, all the way up to 28. That's a big jump. In fact, this is a jump that we haven't seen for a number of years. We have to go all the way back to 2011 and before that to 2007 before we find numbers that we're seeing in this indicator down here, which is percentage B. Percentage B is associated with the Bollinger Bands. It measures how far the VIX, in this case, has moved outside the upper or the lower Bollinger Bands as a percentage. And we are up here at 1.48 above the upper Bollinger Band. Once you hit the upper Bollinger Band, you're already 2 standard deviations away from the mean, which is the 20-period moving average. To be 1.48 deviations above that is just amazing. I mean, this is an amazing, amazing display of acceleration and volatility over the past 2 days of trading. No one really saw this coming to this degree. Everyone was taken by surprise. So plenty of volume in yesterday's trading, in Friday's trading, which indicates to me that a lot of the big money players have already moved to the sidelines. We will probably see more selling early this week, but I do believe, here's the good news, that we will be putting in at least a short-term bottom this week, probably by late Tuesday, early Wednesday. Let me go back to the last time the Volatility Index showed such amazing acceleration, and that was back in 2011. And we saw the VIX shoot from, this is a little higher now, so it has a higher starting point, around 17 to 20. And the VIX jumped from 17.5 all the way up to 47.5 in 2 weeks back in 2011. I don't recall what was causing that back then. Some of you can probably correct me on that. I certainly could look it up. I just haven't yet. But I wanted to show you that in that short order, the major move was from 25 to 48 or so in 3 trading days. I think we're going to get a third day of selling on Monday that will probably abate late Monday, and things will calm down for the next few days. But I do want to show you that when you have this kind of technical damage to a chart, what usually happens in the absence of any major game-changing news, which we have not had yet, in the absence of that, what we should see over the next 2 to 3 months is a sideways consolidation like we see here. This is the VIX trading up and down at the highs, and here's what the S&P 500 looked at during that time. You can see trading up and down at the lows. That's very constructive consolidation. This is actually a good move if you're a long-term bull, because what this sort of churn down here at the lows is doing is it's knocking out weak hands. It's drawing in smart money as they're buying up cheap stocks. And when you get something like this candlestick down here, where you see the lows tested, the breakout comes, and then immediately shoots back up in a nice reversal candle. And look at this, you've got the MACD here making a beautiful bullish divergence off of that low. So you have the price low going lower. You have this beautiful reversal candle being printed right here, coupled with the bullish divergence. That's the kind of thing we want to see going forward. And the market traded very sharply higher and continued to trade higher all the way until last month from this October low in 2011. I suspect we're going to get something like that over the next 2 to 3 months, if not a little shorter than that. That's, things back in 2011 were probably a little rocky on the economy side. Our economy is in a better place now. Let's look at the S&P 500 going forward to today, and this is what we saw last week, this big four-day sell-off, but really it was the last 2 days that just blew things out of the water. And of course we do have a very clear break of support right there, and here's your resistance up here. And if you want to look at a measured move, you're looking at 2130 down to 2040. That's a move of 80, 90 points. Subtract 90 from 2040 and you get 1950. 1950 is our target on this measured move, and I think the futures tonight, here it is Sunday night, are trading right around 1950. I think they hit a low of 1952 last time I checked. So we may well see that 1950 level defended. That's not an exact kind of price. We could see it go up and down even 10 points from that, but 1950 is kind of a good place for support. But I do think that we're going to see a couple days of churn around that area before we see any sort of a big bounce up. I would be very surprised if we could see a bounce on Monday, but it's possible. With that said, then I do believe that we are very near to a nice bottom in this pullback. I don't think we're going to see the market shoot up to new all-time highs anytime real soon, but I do believe that the worst is done on this pullback. Now, if we do get major news that smart money is aware of and the rest of us is not yet aware of, i.e. China collapses, i.e. Iran bombs Israel, i.e. I don't know what happens here in America, maybe some major terrorist attack, God forbid, then all of that changes and we might see something like a collapse that we saw in 2008. But that's a whole different ballgame and there's no predicting that. I want to show you one more quick chart here before we finish, and that is the weekly chart of the S&P 500 to show you that this big stick down was last week, and it is stopping right around the 100 period moving average, which is at 1960, and we've put the measured move at 1950. So somewhere between that 1950 and 1960 area is an area of support, fairly long-term support. We're still in an uptrend. Don't think we've morphed over into a bear market just yet, but technical damage has been done. It usually takes time for that to process itself and work itself out. Frankly, I don't think we're going to have to wait as long as we waited in 2011. I don't think we're going to get that kind of sideways churn that we saw here back then. I would maybe cut this period of time in half, and maybe about a month to 6 weeks from now, we'll be looking at a new uptrend. Either way, we are looking at one of the best buying opportunities that we have seen all year. Now that's really crucial. Here's the beginning of 2015, and you can just see it's been sideways churn without any major pullback until last week. I love pullbacks. I love trading the dips. I love buying cheap stocks when, really good strong stocks when they're trading at cheap prices. And that's what we're going to be seeing over the next few trading days. So stay on alert, stay with the subscriptions. We're going to be calling some good buy points in some major great stocks going forward. We've already got a few lined up for Monday. God bless everyone. Have a great rest of the weekend. We'll see you on the trading floor come Monday morning. Bye now.